I'm Ed Blake, Head of Rates Markets Europe at IGM, and I'm joined by Tony Nyman, Manager of FX Fundamentals. So it looks like the dollar survived Friday's payrolls for now, with the likes of dollar index and dollar yen finding tentative bases at 100.583 and 141.78 respectively. How did you view payrolls, Tony?
Well, Ed, we noted Friday post data that despite the headline NFP's miss of 142,000, the data did not scream recession and hard landing. In fact, the unemployment rate dipped to 4.2%. We suspect that both verdicts for September the 18th by the Fed of either 25 or 50 basis points cuts are still live, though our base case is for the smaller move to start the easing cycle. In our view, it makes sense to go for that, as a deeper easing could risk scaring investors, Americans alike, that the admin are increasingly worried over the recession threat. Ed, are there any levels technically that scream out after the latest dollar rebound?
Yes, Tony. So if you look at the dollar yen chart, you can see that the long-term uptrend has been damaged by the fall from July's 37-year high at 161.95. Strong support has since been found at the August and September lows of 141.70, 141.78. Last Friday's failure to break lower has prompted a corrective bounce. However, we've got bearish multi-time frame studies and the latest depth cross of the 50 and 200 day moving averages, and they combine to suggest limited upside. The recent highs at 147.21 and 149.39 that you can see on the chart should limit any corrective gains, and then we're looking for a return to the 141.70 low. Below there would mark new 8-month lows and expose last December's 140.25 higher low. Another interesting chart is dollar index. You can see that the 5-month downtrend recently accelerated to find support at the end of August at 100.514, and we've since consolidated above that under resistance at 101.917. That was an early September high. Last Friday's bounce from just above the recent low sets up a return to 101.917, and a clearance would complete a near-term double bottom. However, any upside gains are seen limited by clustered resistance around 103.546, 103.650. That's an early August minor lower high and the July low. And it also coincides with the potential double bottom target. Whilst that barrier caps, we're looking for renewed downside amid bearish longer term studies and the recent depth cross of the 50 and 200 day moving averages. And we're looking for an eventual return below the 100.514 low, targeting July 23 base at 99.578. So what are you thinking moves the dollar this week, Tony?
Well, US data-wise, Wednesday and Thursday's CPI and PPI reports are the big ones. CPI is forecast at 0.2% month-on-month and 2.6% year-on-year in August, with the core seen unchanged at 3.2% year-on-year. The Fed should be satisfied with the continued progress made on prices. As ever, markets tend to move on surprises. Otherwise, pre-FOMC ranging could be the theme through the week. I'd also like to point clients to the upcoming 3, 10 and 30-year US Treasury auctions. With yields off sharply, they could be viewed as a test of not only buyer demand, but investor sentiment on the US economy. Finally, it's the first US presidential debate Tuesday. Ahead, Republican candidate Donald Trump has regained a slender lead in the polls over Kamala Harris by 48% to 47%, suggesting the vice president's initial wave of support may be stalling.
Thank you very much for listening. We hope you enjoyed this video. And if you aren't already a subscriber, please see our website for your free trial and to receive expert real-time analysis and data.